All right, let's jump right in. Welcome to this explainer. Today, we're taking a close look at a company that is quite literally building the physical foundation of the global AI boom. Murata Manufacturing just dropped their FY 2025 results, and honestly, hidden right there in the numbers is a massive strategic pivot that anyone following global tech or infrastructure really needs to see. We're going to unpack these stellar results and see exactly how this electronics giant is pulling off a textbook transition, moving from being a heavily smartphone-dependent supplier to becoming an absolutely critical provider for the world's AI infrastructure.
Okay, let's kick things off with a staggering number just to set the stage here. 90%. That is their projected year-over-year growth forecast for data center-related capacitor sales. Look, while the global smartphone market is still, well, pretty challenging right now, this insane surge in AI and data center demand, it's basically acting as a rocket ship for Murata's next phase of growth.
And if that doesn't grab your attention, follow it up with this jaw-dropping figure, a 150 billion yen stock buyback program. To put that into perspective, we are talking about the single largest share buyback in the entire history of the company. When management authorizes a capital return of this scale, it's a massive, flashing neon sign of confidence in their future cash flows and this new strategic direction.
So, here's our game plan for today. We'll cover their strategic pivot, FY25 resilience, the AI server catalyst, breaking records in FY26, their aggressive shareholder returns, and finally, this massive innovation wave.
First up, Murata's strategic pivot from mobile to AI infrastructure.
Let's start by looking back briefly at FY25, resilience amidst change. Despite a pretty noticeable slowdown in high-frequency modules for the smartphone market, Murata still pulled off consecutive record-breaking revenue of 1.83 trillion yen. That's a solid 5% increase year over year. But even more impressively, they managed to maintain their operating profit growth, hitting 281.8 billion yen. Think about that for a second. They essentially absorbed the weakness in the mobile sector and still grew both the top and bottom lines. That right there is the definition of a resilient business model.
What's actually really fascinating about their FY25 performance is the contrast between their different segments. On one hand, you've got absolute robust strength in their core MLCC business. That stands for multi-layer ceramic capacitors, by the way. This segment was heavily driven by surging demand for servers and high-end mobile devices. But on the other side of the ledger, management made a proactive choice to take a 43.8 billion yen impairment loss related to their surface wave filter business. Now, you might think, oh, a loss, that's bad. But actually, scratch that. This wasn't a sign of weakness. It was a strategic cleaning of the balance sheet. They're essentially clearing the decks of underperforming legacy segments so they can ruthlessly focus their capital on where the future growth is.
Oh, and it's also crucial to quickly mention the unauthorized access cybersecurity incident they faced in early 2026. In an era where supply chains are incredibly vulnerable, Murata handled this with total transparency. And the best part? Their primary system stayed completely secure, meaning there was absolutely zero impact on production or sales activities. It's a real testament to their robust internal IT infrastructure and crisis management.
All right, moving on to the main event, Section 3, the AI server catalyst, growth beyond mobile.
The sheer scale of the data center boom they are riding right now is hard to overstate. For FY 2026, Murata expects data center-related sales for their capacitors to grow by an astonishing 85 to 90% year over year. You see, AI servers aren't like traditional servers. They require significantly more components, and those components need far higher specifications to handle intense workloads. Murata is perfectly positioned to catch this massive demand wave.
But you don't capture that kind of growth by just sitting still, right? Murata is dramatically shifting their product mix. They're hyper-focusing on small-size, large-capacity components and rolling out brand new power modules specifically engineered for the crazy energy needs of AI servers. And they are putting their money where their mouth is, committing a massive 250 billion yen in total capital expenditure. That includes an extra 80 billion yen over the next 2 years, earmarked specifically to rapidly expand production capacity for these exact server-grade capacitors. They aren't just planning for the future, they're building the factories for it right now.
Which brings us to Section 4, FY26, breaking records.
So how does this all translate to their financial outlook? Well, they're projecting absolute record highs across the board. We're looking at revenue guidance of 1.96 trillion yen, a solid 7.1% increase. But the real story is the bottom line, a massive 34.8% jump in operating profit, bringing it to 380 billion yen. And what makes this even more compelling is that they've built this forecast on a very conservative currency assumption of 150 yen to the US dollar. That gives them a really nice cushion. Plus, with surging demand, their factory utilization rates are going to be super high. This operational efficiency, combined with internal cost-down initiatives, should more than offset any market price pressures or rising fixed costs. Honestly, it's a masterclass in operational leverage.
Section 5. Aggressive shareholder returns, a major signal to global markets.
Murata is executing a really comprehensive capital allocation policy, and they're treating their shareholders extremely well in the process. First, the annual dividend is getting bumped up to 70 yen per share. Second, as we touched on earlier, they've got that historic 150 billion yen share buyback in play. But the bigger picture here is their total return policy. They're actively targeting a dividend on equity, or DOE, of 5% in the long term, and their FY2026 forecast is already hitting 4.6%. This kind of structured, reliable return of capital is exactly what global institutional investors are begging to see from a mature, yet still rapidly growing tech leader.
Finally, Section 6, the innovation wave.
This quote really hits the nail on the head. Murata is executing a highly strategic, incredibly successful pivot. Now, they aren't totally abandoning their legacy smartphone businesses, but they're making absolutely sure their future is tethered to the most explosive growth sector on the planet, global AI infrastructure. Armed with immense cash flow and a totally dominant market share in high-end MLCCs, they're riding an innovation wave that very few competitors can even hope to match. So here's the thought I want to leave you with today. Going forward, tracking Murata's data center component demand isn't just going to be an interesting data point, it's going to be the ultimate key performance indicator for anyone watching the broader tech hardware sector. As AI scales up, the physical components that make it possible have to scale up too. Will Murata's massive capacity investments hit the market at exactly the right moment? That's the million-dollar question, and it's exactly what we'll be watching closely in the coming quarters.
And finally, just a quick housekeeping note before we wrap up. Please remember that this explainer is provided strictly for educational and interest purposes regarding the source material. It does not constitute a recommendation to purchase individual stocks. Thank you so much for joining me as we unpacked all these fascinating insights. And definitely keep your eyes on how this incredible technology landscape continues to evolve.